Welcome to Breaking News to Trading Moves. We are looking at a specific headline today that, well, it might look like a standard corporate PR update at first glance.
Right. Just regular guidance.
Yeah, but if you actually read the fine print, it acts as a very clear map of the hardware landscape right now. We are talking about HP, ticker symbol H-PQ.
It is a classic case study in market mechanics, really. You have a massive hardware maker telling us that the environment is just getting tougher.
And they issued a warning regarding their fiscal year 2026 outlook.
They did. And the reasons they gave, specifically U.S. trade regulations and the rising cost of memory chips, well, they create a very distinct set of winners and losers.
Exactly. The headline is that HP sees pressure. But for you listening, the trade is figuring out who benefits from that pressure and who else gets hurt. It is a classic margin squeeze scenario.
That is the technical term, yeah. Think of it like a sandwich shop.
Okay.
If the price of the turkey and the cheese goes up, but the customers they refuse to pay more for the sandwich, the shop owner makes less money.
They eat the cost. Literally.
Right. In this case, HP is the shop owner, and the components inside the computer are the turkey and cheese.
And when the ingredients get expensive, the companies selling those ingredients are usually having a very good time.
Oh, absolutely.
So today we are going to look at that dynamic. We will break down exactly what HP said. Then we will move into the winners, the companies benefiting from these rising costs.
And then we will look at the losers, the other companies that are in the exact same boat as HP.
Right. And we will attach specific stock tickers to each of those categories so you can see how this actually plays out in the market.
Sounds good. Let's start with the news itself.
Yeah. What exactly did HP announce?
So HP, again, ticker HPQ, announced that U.S. trade rules and rising costs for memory chips are expected to weigh on their fiscal 2026 outlook.
Okay.
Management specifically guided toward the low end of their prior earnings per share range.
And the low end of the range is never what investors want to hear.
No, it is not. The market reacted exactly how you'd expect. The stock dropped in after hours, trading right after the update. But the specific reasons are what matter here.
They called out ongoing volatility in DRAM and NAND pricing, right?
Yes, DRAM and NAND.
Let's pause on that for a second because we see those acronyms all the time in tech specs. What is the practical difference for you, the user?
Right. Think of it like a physical desk. DRAM is the top of the desk. It is your working memory.
Where you do the active work.
Exactly. It is where you put the files you are working on right now. If you have a small desk, you just can't do much at once. That is DRAM.
Okay. And NAND?
NAND is the file cabinet drawers. It is storage. It is where you keep things when the power is off or when you aren't actively using them.
Got it.
So HP is saying that both the desk and the file cabinet are getting more expensive to buy.
And on top of those rising component costs, they flagged a volume warning too, didn't they?
They did. They flagged a likely double-digit decline in PC shipments.
Double-digit
Yeah.
decline. That is a very heavy drop in the number of computers being sold.
It is a volume shock. So you have a situation where they are selling fewer units, and the units they are building are costing them more to make.
That is the definition of a difficult spot.
Truly.
Okay, let's look at the mechanics of this squeeze before we get to the other tickers. Walk us through how this plays out for a company like HP on the assembly line.
It starts with the bill of materials, or the BOM. This is the list of every single part that goes into a laptop. The screen, the battery, the casing, and of course the memory.
Right.
When the memory suppliers raise their prices, that BOM cost jumps up instantly.
So HP just has to write a bigger check to get the parts they need to build the machine.
Right. Now, in a booming economy, HP would just pass that cost directly to the customer.
They just raise the retail price.
Exactly. If the laptop cost $10 more to make, they would charge $20 more on the shelf.
But they can't do that right now.
Not easily, no.
Yeah.
Remember, they just told us shipments are dropping by double digits. That means demand is already weak.
People are holding on to their money.
Right. Consumers and businesses are extremely price sensitive right now. If HP raises prices to cover their costs, they risk killing demand even further.
So they have to eat the cost.
They have to absorb it. And that eats directly into their gross margin. Then you add the trade regulations on top of that.
What does that add to the mix? Is it just a tax?
It is a tax,
Yeah.
but it is also friction. It creates uncertainty about where they can source parts from and how much those parts will cost when they cross the border.
It makes planning impossible.
It makes inventory planning a nightmare because you don't know if your supply chain is going to be disrupted next week.
So the takeaway here is that the standard market for selling computers is weakening and the costs to make them are going up.
That is the reality. Margins are being compressed because they don't have enough pricing power to offset the rising component costs.
Which brings us to the most critical part of this discussion, the winners.
Yes.
Because if HP is paying more for memory, that money isn't just evaporating. Someone is catching it.
That is the very first place to look. If you want to trade this news, you look at the memory suppliers.
So who are the main players here catching that cash?
The two big ones to watch are Micron and Western Digital. Micron is ticker MU. Western Digital is ticker WDTC.
MU and WDC. Why are they the clear winners here?
Because they possess the pricing power. When HP complains about volatility in DRAM and NAND pricing, what they are really saying is, Micron and Western Digital are successfully charging us more money.
It confirms that the suppliers currently have the upper hand.
Precisely. Rising pricing for memory generally expands revenue and margins for these suppliers. If the PC makers are feeling the pain of high costs, it usually means the component makers are enjoying the benefit of high prices.
Now, memory is famously cyclical. Usually when PC sales drop, memory prices crash because nobody is buying chips. Why is it different this time around?
That is the key question. Why are prices going up if HP is selling fewer computers? The answer is that there is a bigger, much hungrier customer in the market right now.
The data centers.
Exactly. This connects to our next group of winners, the AI compute ecosystem.
Okay.
HP explicitly tied the volatility in memory prices to AI-driven data center demand.
So the data centers are just buying up all the memory chips for AI servers, leaving less for the PC guys.
Effectively, yes. The demand for AI infrastructure is massive. These data centers need huge amounts of high-speed memory. If you are a memory manufacturer, you only have a limited number of wafers you can process a month.
You have to choose what to build.
Right. Do you build cheap memory for a budget laptop that isn't selling well anyway? Or do you build high-performance, high-margin memory for an AI server that is sold out for the next 12 months?
You build the AI memory.
You build the AI memory every single time.
Yeah.
That creates a shortage for the standard PC memory, which drives the price up for HP.
So who wins from that dynamic specifically?
The leaders in AI compute. That is NVIDIA, ticker NVDA, and AMD, ticker AMD.
NVIDIA and AMD.
As long as that data center build-out continues, the demand for memory remains high, which squeezes the PC market. But for NVIDIA and AMD, this is pure validation.
Validation that the spending is still there.
Exactly. It proves the AI boom is still consuming resources at a rate that distorts the rest of the entire hardware market.
It is like the data centers or the VIP customers buying all the expensive champagne, and the PC makers are stuck trying to buy whatever is left over at the bar.
And paying a heavy premium for it. So if you are looking at this HP news, one angle is that it confirms the AI trade is still running very strong.
Okay, there is one more group of winners you identified, which I found notable because it seems a little contradictory at first. You called this premium CPU platforms.
Yes, this is a bit more nuanced. Even though HP said total shipments might drop, they noted that premium TCs and AI-powered PCs are making up a meaningful share of what they do manage to sell.
So people aren't buying the cheap, everyday laptops, but businesses might still be buying the expensive, high-end ones.
Exactly. When costs rise, PC makers like HP try to push consumers toward high-end models because there's more profit margin baked in there.
That makes sense.
They want to sell you the expensive machine to protect their earnings.
They need that higher price tag to cover the higher component costs.
Correct. They are trying to alter the product mix. They would much rather sell one $2,000 laptop than three $300 Chromebooks.
And who makes the brains for those expensive machines?
Qualcomm and Intel. Qualcomm is ticker QCOM, and Intel is ticker INTC.
QCOM and INTC.
These companies provide the high-end silicon platforms for those premium and AI PCs. So even if the total number of computers sold goes down, the mix of computers being sold favors these higher-end processors.
I see. If HP is going to sell fewer computers overall, they are going to try very hard to make sure the ones they do sell have the expensive chips inside.
Which supports the revenue for Qualcomm and Intel, relatively speaking, compared to the makers of standard budget components.
Okay, those are the winners. The memory guys, the AI giants causing the shortage, and the premium chip makers. Now let's flip the coin. Who gets hurt by this? Obviously, HP is on the list.
HP is the headline, yes, but this applies to the other big PC original equipment manufacturers, or OEMs. The other big name to watch here is Dell Technologies, ticker DELL.
DELL. They are in the exact same boat as HP.
Very much so. They face the exact same cost structures, they buy the same memory chips from Micron and Western Digital, and they sell to similar corporate and consumer markets.
So if memory prices double or stay volatile, Dell's gross margins are at risk too.
Unless they can raise prices perfectly without killing demand, which, as we discussed, is very hard to do when the market is already shrinking.
Right.
If HP is warning about a double-digit shipment decline, that is a negative signal for Dell's operating leverage as well.
Let's break down operating leverage for a moment. What does that actually mean in this specific context?
It is about fixed costs versus variable revenue. Dell and HP have massive factories, R&D teams, and global support staffs. Those are fixed costs. You pay them whether you sell 1 computer or 1 million computers.
Right. The lights stay on either way.
Exactly. If you sell a lot of computers, those fixed costs are spread out and you make a lot of profit. But if your sales volume drops like that double-digit decline HP mentioned, those fixed costs eat up a much larger percentage of your revenue. Your profit falls much faster than your sales do.
That is the danger zone. Okay, so stay cautious on the OEMs. But the pain doesn't stop at the manufacturers. What about the stores that actually sell these computers?
This is the retail and distribution group. If fewer PCs are being sold, the companies that sell them to you and me or to businesses are going to feel it.
Who are the tickers here?
Best Buy, ticker BBY, and CDW, ticker CDW.
VBY and CDW.
CDW is a giant for corporate IT sales. If companies are delaying their PC refreshes because of budget cuts or high prices, CDW feels that immediately. Best Buy is obviously the consumer giant.
And with Best Buy, I imagine it is not just about the sale of the laptop itself, right?
Correct. It is the attach rate. When you buy a computer, you might buy a warranty, a mouse, a carrying case, maybe a software subscription.
I always end up buying the expensive display cables I didn't think I needed.
Exactly. And that is where the margin is for retailers. They make very little money on the laptop itself. They make their real money on the cables, the warranty, and the service plan.
So if I don't buy the laptop, I definitely don't buy the cable.
Right. A double-digit decline in PC shipments eliminates all those high-margin add-on sales. It is a compound hit to their bottom line.
Speaking of accessories, that leads us to the final group of losers. You called this peripherals and office hardware.
It is logically connected. If people aren't buying new computers, they probably aren't refreshing their keyboards and webcams either.
The tickers to watch.
Logitech, ticker LOGI, and Xerox, ticker XRX.
LOGI and XRX. Logitech makes perfect sense. They make the mice and keyboards. If I keep my old laptop, I keep my old mouse.
It's exactly. A weaker environment for PC shipments hits everything physically connected to the PC. And for Xerox, it is about office gadgets. This actually brings us right back to the AI issue.
Wait, how does AI hurt a copier company?
It is about budget displacement. Most corporate IT departments have a fixed budget for the year. It is a zero-sum game.
Meaning if they spend $1 on one thing, they physically cannot spend it on another.
Right. If the CEO says, we need to invest in AI, the CIO has to find the money for those expensive GPU servers somewhere. Where do they take the money from?
The boring stuff.
Exactly. They delay upgrading the printers, they delay the copier contracts, they cut the legacy hardware spend to fund the new AI initiative.
So the money flowing into AI is literally taking budget away from the traditional office hardware.
That appears to be the trend. The shiny new object is cannibalizing the budget for the legacy infrastructure.
Okay, we have covered a lot of ground here. We have the news from HP, the mechanism of the margin squeeze, and the specific tickers for winners and losers. Let's bring this down to actual trading scenarios. If you are looking at this landscape, how do you group these ideas?
I would frame it in 3 scenarios.
Let's hear scenario A.
Scenario A is bullish memory. If you look at HP's warning and say, wow, memory prices are really going up and staying up, then you look for relative strength in the suppliers. That is Micron, ticker MU, and Western Digital, ticker WDCC. You bet on the ingredient sellers.
Because they have the pricing power.
Correct.
Okay. Scenario B.
Scenario B is bearish demand. If you focus on the part where HP said shipments are dropping double digits, you want to be extremely careful with anyone tied to volume. You watch for downside in HP, ticker HPQ, Dell, ticker DELL, and the retailers like Best Buy, ticker BBY.
You stay away from anyone who needs to move boxes to make money.
Right. If the consumer's walking away, you don't want to own the store.
And scenario C.
Scenario C is AI dominance.
Yeah.
You look at this and say, the only reason costs are high is because AI demand is insatiable. In that case, NVIDIA, ticker NVDA, and AMD, ticker AMD, remain the beneficiaries because they are the ones driving that scarcity.
You treat the memory shortage as just another signal that the AI cycle is still running hot.
Exactly. It validates the structural demand for compute power.
Now, what are the risks here? What could go wrong with these theses?
So the biggest risk to the memory trade is speed. The memory market is famous for boom and bust cycles. If supply responds too fast, if Samsung or Micron builds too many factories too quickly, prices could cool down. That would hurt the memory stocks.
So if they flood the market with chips, the pricing power vanishes.
Yes, it has happened many times before.
And for the AI trade?
If AI demand slows down, if the data centers stop buying, the memory shortage vanishes and prices crash. The entire thesis rests on that capital expenditure continuing at this pace.
And for the OEMs like HP and Dell, is there a good outcome for them?
There is. They might be better at passing through prices than we think. If they manage to raise prices and consumers somehow keep buying, their margins might hold up better than expected. They are efficient operators. We shouldn't count them out completely.
And of course, the wild card we started with.
Trade and tariffs. Headlines can change overnight. New regulations could completely alter the cost structure or the supply chain map. That is a risk that is very hard to model. You just have to stay alert.
It really is a fascinating puzzle. One headline from HP opens up this whole web of connections across the entire tech sector.
It does. And it leaves you with a broader question to think about regarding pricing power. In a hardware war, is it better to own the brand on the box or the essential commodity inside it? Right now, the market seems to be favoring the commodity.
That is a great point. And it makes you wonder what happens when those massive AI servers eventually age out and need replacing. Does the cycle just repeat itself, but even more aggressively? Definitely something for you to explore on your own.
That is the next big puzzle for sure.
Well, just a reminder to our listeners, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own research.
Thanks for listening to Breaking News to Trading Moves. We will catch you next time.